What's up, everybody? Zach is back with another episode of Journey to $1 Million. It is the start to what is hopefully a bad week. I really hope that the economy is not good, and I hope that all of the data that's coming out is bad. I hope all of the earnings this week are horrible. Why? Because apparently it's opposite day, and that's just how things go in 2021. And I wish I could say I was kidding, but I'm not. the jobs report that was published on last Friday was horrible. We were expected to add 1 million jobs in April, and we actually only ended up adding 226,000, something like that. So super bad, absolutely horrible. And stocks went up. So that's where we are right now. With the bad news is actually good news for the stocks, and the good news for the economy is bad news for the stocks. And you know what? I say stocks because really what I'm talking about is growth tech stocks, which probably if you watch my channel and you're following me on my journey, that might be what you're interested in. But yeah, it's kind of weird. And really what it boils down to, a lot of people were asking me, because I was posting this when the reports were coming out on my Twitter, and a lot of people were asking me, like, what's going on? Can't make this stuff up. It's opposite day. And yeah, I mean, so the more that you think about it, the more that it makes sense. And I'm not kidding. So actually, if the economy was really, really good, then the investors would be scared that the Feds are going to raise the interest rates. So that is where this is mostly stemming from. Now, we don't want to raise interest rates, that's for sure. That's going to be a little bit painful. It's eventually going to happen, but the Fed is saying it's not going to be until at least 2023. Now, the issue with that is people don't really believe it because so far everybody's getting vaccinated. The earnings have actually been really good. And everything is opening back up a lot faster than we expected. So that's the problem. It's a lot faster than we expected. It's better than we expected. So do we really need to keep interest rates this low until 2023? That's the point. So investors are a little bit nervous that actually it's not going to be until 2023. Actually, they might step in early and start manipulating some things, buying back bonds, raising the interest rates. And that's going to freak everybody out, and it's really going to cause some sort of a mini crash, pretty decent pullback, I assume. And I'm assuming that because even when nothing happened and people are just thinking like, well, even the Fed is saying they're not going to do it until 2023, and people are thinking like, well, maybe they will. Maybe there's a possibility that they will start raising interest rates. And then the markets just crashed like you saw in March and early last week when the data was coming out. Good. Now, what happened on Friday was the data came out and was horrible. Again, we expected 1 million jobs and actually only more than 200,000 were added. So that's sounds just devastating. So it actually emphasizes the point that the economy is not recovering as fast as we thought. We are not adding as many jobs as we thought. It's going to be slow recovery. And that actually gives the investors confidence that what the Fed is saying, we're not going to raise the interest rates until 2023, is probably true. We don't want to raise the interest rates. Raising interest rates is bad. Interest rates are so low right now. Money is cheap. Money is at the cheapest point it's been in a long time. So all of these high growth innovation tech stocks, they can borrow money to have all of the working capital that they need, basically almost for free. And that gives a huge boost. Now, once the interest rates go up, the money gets to be a lot more expensive. But in the long run, that along with the inflation fears, inflation is going to even out. Maybe it's a little bit more right now, but then later it'll be a little bit less, and then it'll all average out. At least that's what Mr. Powell is saying. But in the long run, everything will be fine. And actually, the economy is doing fine. It is recovering. Some of the reports coming out are really good. Some are really bad. So, yeah, I'll take it with a grain of salt. I don't think anything horrible is coming down the road. And actually, if the data comes out really poor, the tech and growth and innovation are really going to start taking off because everybody is confident that Well, hold on. Maybe the interest rates really won't go up until 2023, and the money starts flowing back into the tech and growth. And on the opposite side, if the next week or this later this week some good economic data comes out, then probably tech is going to sell off, and the money would go back into the financial sector, bank stocks, cyclicals. I could say big box maybe, and different industries like this. Those old worn out Dow Jones stocks. The companies that haven't ever turned a profit before. The companies that had, last time they turned a profit was in like 1995. Those are the ones that are going to go up. But seriously, you can't really make this stuff up. But if you think about it, it actually makes a lot of sense. So now the question is, I don't know what's going to happen. Is the economy going to recover fast, or is the economy going to recover slow going forward from now? Well, who knows? But I think the general feeling is the economy is going to be fine and is going to recover a lot faster than at first expected. I mean, at first, so like when we were in the middle of the COVID. So I think that's why the cyclicals, the Dow is setting all-time highs right now, while NASDAQ is not doing very well, and growth and innovation is doing horrible. So I think that would be the correct temperature to take. So again, the question is, which stock should we invest in? For sure, that's the question. What's making money? I have plenty of stocks and ETFs that are underperforming. And I don't know, because of what's happening right now with the interest rates and the fear. Even though they're not going to raise the interest rates till 2023, that's what they said. But apparently, people think that Jerome Powell is a liar, apparently. And I don't really blame him. Even Yellen comes out and says, well, maybe we should start manipulating things earlier. But hey, it is what it is. So I think that it would be a good play to add money into the UDOW, NAIL, FAS. Those are 3 ETFs which we covered from the last report of last week. Came out on Friday. At opening bell, I had that report out covering NAIL, UDOW, and FAS. And just to review, UDOW is the 3X Dow Jones ETF, just an index ETF. NAIL is the U.S. housing, the U.S. Dow Jones housing home builders ETF. And everything to do with new home construction, which is really could be an awesome opportunity right now. I think it was up like a lot on Friday. It finished a lot. Finished pretty high. Yeah, it's 5.9% on Friday. It actually, well, including after hours, 6.96, almost 7% since I published that article, which is kind of a lot. No big deal though. So hopefully you bought into that one. Really, that one's an interesting one because I know firsthand that the U.S. home market is just fire right now. It's just on fire. The prices are going up crazy fast, and there is going to be a huge demand for new construction, single family homes. I mean, there's going to be a huge demand. So I think the NAIL, and it's a 3X one, so it's a leveraged one. You can always get the non 3X one, but personally I think let's spice it up a little bit because sometimes the ETFs can be a little bit slow moving and boring. Not the ARK ones though. Those are sometimes painful and sometimes nirvana. But yeah, so UDOW, NAIL, and then the last one I would say is FAS, which is the financial sector, basically JP Morgan, Goldman Sachs, Berkshire Hathaway, Wells Fargo, Citibank, Citigroup, and it's a 3X. So again, those are just the 3X versions because I like to keep it spicy, but of course you don't have to keep it spicy. But those are actually doing really well this year. And on the opposite side, if the economic data is just horrible going forward, which it might be bad. I mean, we just came out of a pretty big dip, especially for a lot of sectors. So I wouldn't be surprised if it is horrible. I wouldn't be surprised if it's not horrible. I mean, anything could go. So if it is horrible, then I think something like TQQQ, any of the ARK ones probably would do really well if the economic data was horrible, because those interest rates are going to be low. Also Soxel. But yeah, go ahead and take a look at this new write-up that I have available, prostockadvice.com/blog. The latest one is available. I'm posting it on Twitter. I'm doing the trading on Twitter, short-term options, mid-term swings, any of the actual trades I'm doing, I am posting them on Twitter in real time when I'm executing them. At least I try to post it as fast as possible. So go ahead and follow me on Twitter and hit the like button while you're down there in the YouTube comment section. If you have any questions, let me know. But nevertheless, this week, going in, we're going to have some pretty interesting earnings coming up. Looks like we're going to be Looking at Alibaba earnings are coming out, Xiaopeng coming out, which two of those two I'm really interested in to see where it's going. Especially they just gotten beaten down. Lemonade, which the OGs know I really like Lemonade. I'm actually a long-term Lemonade customer myself. I really like Lemonade. Streamlines the insurance process for millennials. Is pretty cool. As an app. Anyways, guys, check that out. And the earnings are coming out for that one, and then also Roblox, which is a new one that we live streamed the launch, the IPO. Nevertheless, I went ahead and pulled up this chart, this Lemonade. A lot of charts look like this right now. It's up and down and up and down and up and down. Very flat for the past month or so. And it had set all-time highs, crashed during the end of February, March dip, and since then it's been flat. And right now it is at a low point, so we don't know. Last week was bad. So we don't know if these growth and innovation is going to make a push forward next week. Depends on the economic data is bad, I guess. But we're going to keep watching. And I think, yeah, I only put one chart up here on the blog because they pretty much all look the same, guys. They're literally, we're at all-time highs before March, crashed, and it's pretty much trading sideways. For all of the ARCs, basically, Lemonade, Alibaba, Xiaopeng, Roblox, they all look like this. And there's a lot more growth tech innovation that look like this. But anyways, that's basically all I have for you guys today. Thanks for tuning in again. I do appreciate you guys. This is a new YouTube channel, so I really appreciate if you guys share it around, smash that like button, leave some comments. If you have any questions, let me know. We just finished the first webinar series, the Stock Options and Investing 101 to 103. And yeah, I mean, had a really good time with that. Hopefully everybody learned a lot of things. Let me know if you were in it in the comment sections, and that if you do watch these videos, which is really cool. But of course, we're going to have some more of those webinars coming up, more beginning, intermediate, and advanced level for stock options and investing. So I'm going to do some thinking on it and what we could do and what I think best suits the different level and the different courses. But they're live courses. Nothing is pre-recorded, so people can ask questions. It's pretty cool. And other than that, I do still do the one-on-one if you guys are interested in that. It does really help out because that's basically all I can get out of this. So I would really appreciate that if you want a half an hour or an hour of my time. Hit me up in the DMs on Twitter or on my website through the contact box. But anyways, guys, I appreciate it again, and I will see you on the other side. Peace.